Maximizing Price Stability in a Monetary Economy by Warren Mosler and Damiano, Silipo. Section 7b. Accounting. The accounting for the ECB payments to the transitional workers in the employed labor buffer stock per se are of no real economic consequence. However, the nominal expenses do carry serious political considerations under the current institutional structure. For example, should the ECB simply expense the payments, ECB stated capital is reduced. While operationally capital denominated in its own currency is of no practical consequence for a central bank, there are currently politically determined consequences. For example, in the EU, there is a political requirement for the ECB to be capitalized, and if expenses reduce capital, the ECB is required to make capital calls to the member states, which are further required to comply with debt and deficit limits. The following financial proposals, therefore, are presented only in response to current political realities. The first political decision is whether the expense for the buffer stock wage should be accounted for with an allocation to each member nation based on expense incurred within its boundaries, or whether the expense should be divided pro rata based on total population. Given that unemployment compensation is currently paid by the member nations, we are proposing to account for the nominal cost of the transitional buffer stock employees in the same way, even though we are proposing that the transitionally employed labor buffer stock be managed directly by the ECB as an additional tool for meeting their price stability mandate. The additional cost per member will be partially offset by savings on various transfer payments previously paid to unemployed workers who opt for transitional buffer stock employment, with any additional net cost adding to current spending. To prevent the additional expense from reducing the stated capital of the ECB, again, assuming reduced capital would be a political obstacle, member nations could issue transferable tax credits to the ECB equal to ECB expenses with regard to wages and associated costs of the transitional buffer stock workers. These tax credits would be assets on the ECB's balance sheet, and the euro balances credited to member banks as payment for said wages and expenses would be the equal liabilities. Should it be deemed necessary for the ECB to convert the tax credits to euro, something we cannot foresee under any circumstances, the tax credits could be sold to ECB member banks at face value, and the member banks could then use them on behalf of their depositors as they make tax payments to the member nations.